Yes, today is a very great day in terms of the number of webinars we have hosted. And today is the webinar number 100. So few highlights of these 100 webinars. The first webinar was held on 9th of April 2020, almost 15 days more than 1 year. All the content shown to you, all the presentations were original creation by us and prepared in-house. Topics broadly can be categorized under the stocks, the portfolio, financial freedom, then how to manage emotions. That is a very challenging topic. And for that also, we have made about 18 webinars on managing emotions, and then the investment 10x. Total of 9,361 participants during these 100 webinars. Average webinar duration was 1 hour and 7 minutes. Of course, this is including the question answer session. Total webinars duration is 111 hours. That is the 1 hour and 7 minutes multiplied by 99. In fact, today is the 100th webinar. So whatever data I have produced here is for the last 99 webinars. Average preparation time per webinar was 6.5 hours. Yes, we spent whatever we show you in 35 or 40 minutes of presentation, it takes about 6.5 hours on an average at our end. So we have spent about 644 hours to prepare these presentations and the contents for these webinars. And all this content was open. All these webinars were open and free for all. Thank you very much. Thank you for sparing your valuable time. Total time spent by the participants was 60,847 hours. Yes, total aggregate time spent by the participants. That is a great, big number. We have received feedbacks and suggestions, 9 in number, 319 words of appreciation. Thank you very much for that. And thank you for listing topics. 11 topics have been suggested by the participants. And thanks also for bearing with me. And one of the webinars I had to cut short. In fact, I have to suspend because of the emergency at my end, and I can truly appreciate that my 1 hour is equivalent to your aggregate 100 hours on an average. I am also thankful to my team for regular guidance, and the team is inclusive of Mr. Kishore Purswani, Madam Namita, and Mr. Siddharth Shah. And also I'm thankful to all of you, and because of these webinars, we have been able to launch a new product with the name of Smart Insights Pro. As you all know, this we have launched about 4 months ago, 4-5 months ago, and this consists of the collection of short videos about 20 minutes each for equity research, for financial freedom, for managing emotions and portfolio management. So this was all about our 100th webinar, and we are celebrating our 21st anniversary for Smart VRC. So our today's topic is portfolio design in current uncertain scenario. Yes, I know you all are very much worried what will happen to the markets because of the rising COVID cases, and really it is a very scary situation as far as the COVID is concerned. Not many casualties are happening, and not many people are suffering from different reasons. I feel really very sorry. Take care. That is the best I can guide you. It is in our hands. Yes, we can protect ourselves. At the same time, I know as far as your investment in the stock market is concerned, majority of the investors are really worried whether the market will crash from the current levels. So how you should act, whether you should sell, whether you should invest more at the current juncture, or you have to rejig your portfolio. So I will always go with reorganizing the portfolio. So what we are going to cover in this presentation is why portfolio design is crucial, global scenario, domestic scenario, sectors to be avoided, sectors to be included, and a balanced portfolio. So here is a small image and also a poll for you. What can we do to stop living in market fear? Switch TV. First option is to movie channels. Second option is switch TV off and sell everything. Third channel is switch TV off and sleep. And the last option is switch off the TV and reorganize your stock portfolio. So the options must be appearing on your screen. %, 57% of the participants have already voted. I request all of you to participate. Only 5 seconds left. So here are the results. 6% say that switch off the TV and switch to movie channel. Yes, maybe because their portfolio is perfect and they are not worried about the market and they want to enjoy, they want to relax and watch movies. There is no one who says that switch off and sell everything. I'm very happy to see that. No one is ready to sell everything. And 1% of the participants say that switch off and sleep. Okay, that can be up to an individual, but I would not like to sleep for a long time because opportunities may come at any time, either to buy or to sell. And last but not the least, 93% of the participants say that switch off the TV and reorganize your stock portfolio. This is also correct, as we have already discussed. So this was all about the poll results. Now, why the portfolio design is crucial? Because it is the portfolio returns that counts. Individual returns in terms of percentage have little relevance until unless you have made a suitable allocation to the portfolio. I have a client about 6 years ago. He told that he had purchased many of the stocks based on various advices, not only from us, but also from the other advisors. And he spends about 4% of his portfolio size for availing the investment advisory. And he wants an advice on his stocks from us. So we offered Dr. Smart, one of our services, Dr. Smart, and he sent me the portfolio, and you'll be surprised to know that the portfolio had 207 stocks. Now, and of course, he had very good stocks also, like Page Industries, HDFC Bank, and many others, like MRF also he was holding. Unfortunately, the weightage allocated to these stocks was very small. Weightage was only about 0.5%, 0.6%, something like that. So even if HDFC Bank rises by say 100% in a year, and if you have a weightage of only 0.6%, then your portfolio will rise by only 0.6%. So that is why the portfolio design is very crucial. And there are other factors also, and that we will discuss as we proceed into the further slides. Allocation. With the same set of stocks, suppose I give you 20 stocks. Now from those 20 stocks, I can create infinite number of portfolios based on varying the allocation. You can have more allocation for risky stocks, you can have less allocation for risky stocks depending on your risk profile. So it is not only the stocks which you select, but also how much weightage, how much allocation आपने उस स्टॉक का कितना वजन दिया है उस पोर्टफोलियो में, वो भी डिसाइड करेगा कि how much returns you are going to get. So that also plays a very crucial role. Now the kind of stocks. First is the lifters. Lifters means in whatever situation, these stocks will provide an upside boost. Why? Because these stocks are going to report a very good set of numbers. When I say numbers, I mean the financial numbers in the foreseeable future. In the foreseeable future means in the very near future. So these are the lifters. Then there is a second category that says don't care. Wherever the market moves, they will also move, but at a very, very slow pace. They are hardly bothered about the market movements. So these are don't care. Then we have bulldozers. Bulldozers means if the tsunami comes in the stock market, they will simply bulldoze your portfolio. Yes, they have the power to reduce your portfolio to ashes. They can fall very, very steeply. Now, first is the lifters. As I said, these are the stocks whose good performance in the very near term will keep its price boosted up. In the current scenario, what are the examples? Export-oriented companies. Export-oriented, it depends on sector to sector, and within the sector also, it depends. Some companies may be serving to the domestic market and some may be export-oriented. Like in two-wheelers, Hero Honda is mainly serving the domestic market, while Bajaj Auto is mainly serving the export market. It is the same sector, two-wheeler, but the focus is different. Then similarly in auto ancillaries, there are companies which have more than 90% export and only 10% they are serving to the domestic market. IT, most of the IT stocks are export oriented. So why I am expecting a good performance from export oriented companies? There are two counts. One, the developed countries, especially this whole of Europe and even USA, they are fast coming out of this COVID infection. They are very fast in the vaccination drive, and their population is pretty small and compared to India, and they may come out of this COVID infection pretty fast. And as we all know, our country is suffering very heavily. So the companies over there in these developed countries, they may grow in terms of revenue. They may demand more raw material from India. They may demand more services in terms of the IT companies from India. So export-oriented companies are expected to do well. Then we have pharmaceuticals. Pharmaceuticals, especially in the mid cap and small cap, there are good companies which are growing at a good growth rate, not only in terms of export, but also in terms of serving the domestic market. So this is another sector where we can find the lifters for our portfolio. Then we have the commodity stocks like steel, copper, and other metals also, whose prices are dictated by the international markets. When I say international, it includes all international, means it includes US, includes China, it includes European countries. So this is another sector where we can pick the lifters for our portfolio. Now, this is another way of explaining you what happens in terms of the lifters. Lifters are expected to report very good results, at least for the next year. Rest of the years, these are only the projections, but for the next year, we are expecting good jump in terms of the percentage, in terms of the EPS. So this is the past performance of 2020-21, and this is for the next year. So actually what happens when the market falls? Under normal circumstances, when the market keeps on rising, it tries to discount the future earnings. So under normal circumstances, what happens? Market discounts the next year earnings or next to next year earnings. If the market rises further, then it tries to discount 3 years hence or 4 years hence of the earnings per share. But if there is any kind of crisis in the market, then investors immediately switch to the latest performance. To the latest performance is 2021. So maybe in times to come, the performance may be very good for 4 years or 5 years hence, but in the immediate future, the performance is 2021. And in the forthcoming quarters also, in case of lifters, there is a good possibility of good jump in earnings per share. So lifters will protect your portfolio from falling down. Not only they will protect, but they will give a boost to your portfolio. So that is the role of lifters in a portfolio. In terms of a spring, it is like this. So there is a substantial scope for further stretch. Then there is a second category, which is don't care. When I say don't care, there is the defensive. These are the stocks with very sound fundamentals, but not so encouraging future prospects. Yes, I repeat, with very sound past performance, but not very encouraging future prospects. They are regularly declaring very decent dividends. Dividend yield is pretty high, and the earnings are almost very clear to everybody what kind of growth they can lock, and you cannot expect any surprises either on upside or on downside from these stocks. These are non-cyclical stocks. I am very sure you must have understood what kind of stocks, what kind of categories of sectors I am talking about. The first is FMCG. It is non-cyclical because they are serving to the necessity. Their products are a necessity. Then utilities, again, utility, when I say utility, means the power, water, and all those things. These are utilities. And these are the two sectors mainly from where we can find the don't care. But why we need don't care? When we know very well that they cannot give you very high returns. But in times of sharp fall in market, these are the stocks which can protect your returns. They cannot give you good returns, but they can protect. They will not fall. I'll give you some examples. Now, this is the EPS growth. As you can see, the expected growth is very linear and very slow growth. Examples are Hindustan Unilever. During last 1 year, as you can see, the lowest is 2,000 rupees and highest is 2,500. This very, very limited channel where the share price moves. In fact, if you look at the today's price on year basis, there is hardly any gain. In fact, it is 0, no return. But in terms of Sensex, you will agree that market is up by about 60 to 70%. So these are the stocks which on the upside also will not give you good returns. On the downside also, they will not fall much. This is another example from the utilities, and this NTPC, and almost a very similar story. As you can see, the stock price is most of the time has remained between 80 rupees and 115 rupees. Very, very narrow channel, I can say. And again, the returns are on year basis. 1 year ago, the share price was about 90 to 93 rupees, and today it is 103 or 105 rupees. So hardly 10% returns, 10-15% returns, very small returns compared to the Sensex. This is a Coal India, almost the same story. In fact, in Coal India, the share price is down on year basis, and the range is again very narrow, between 115 to 160. For 160, it was above 150 for a very short period of time, but most of the time it is around 125, 130 rupees. So these are the defensives. There is spring action, as you can see, already very tight. They cannot come down highly, neither they can go up. Sorry. Now there is one more category, and bulldozers. There is a very interesting category. Stocks with poor or excellent credentials. How can it happen? Stocks with poor, either very poor or very excellent credentials. Yes, these are the stocks which fall the most whenever the market falls, either with very excellent credentials or with very poor credentials. Why? I will let you know. These companies are expected to deliver very poor results in the near term. I'll give you an example. During the last crash, the stock price of Bajaj Finance fell down from around 5,000 rupees to about 1,700 something rupees. Bajaj Finance, we all know, has very excellent credentials, but still it fell like this. Why? And there are many more other stocks which very poor credentials, they also fell by 60%, 70% or 90%. And these are the stocks which command exorbitantly high P ratio. Exactly. The companies with very poor credentials or with very excellent credentials, they normally command high P ratio because people are expecting high performance from these companies. So you must have observed that it is better to go with excellent credentials rather than the poor credentials, because whenever the market bounces back, it is the excellent credentials stocks which bounce back the most. So these are the bulldozers. They can really bulldoze your portfolio. But it is the excellent credential stock which can bounce back very fast and with great vigor. So in case of bulldozers, we don't know what is going to happen. Now, this is the case for stocks with poor credentials. This is not the case with stocks for excellent credentials, but with poor credentials, you never know what is going to happen next year or next to next year or 2 years hence. So what people are betting is only for speculation purpose. They are only speculating. Credentials are not there, but people expect some big returns, maybe because of the poor advice they are taking, or maybe because of the artificial stories built around the social media. So, as I have told you, there are 3 categories, and there are lifters, there are defensive stocks, which we say don't care, and also there are stocks which are known as bulldozers. Right now, of course, the sentiments are very low, and people are asking me where to invest, sir. Market has fallen. But where the market has fallen? Has it really fallen? Index highest point was 52,000 and something, about 200 points. And today it is 47,500 or near about. So the fall is about 8%. 8% is not a great fall. 8%, you cannot say that the market has fallen. 8% is not a crash. Only the sentiments are low. Market has not fallen. So don't get mistaken. Only the sentiments are low. Market is still pretty high. But check your portfolio, how much it has fallen from the peak from last 2 months or from last 3 months. I'm very sure all of you must have observed that your portfolios touched dizzy heights, how much they have fallen. Index has fallen by 8%. What about your portfolio? That will tell you what kind of stocks you are holding. So based on these three categories, we are coming out very soon. Maybe tomorrow we are coming out with a smart report on one of the lifters. Yes, there's a very strong lifter and it can lift your portfolio returns. Of course, we are going to allocate about 4% or 5% of the weightage for the portfolio. So on proportionate basis, it can lift your portfolio and it has got sound prospects, at least in the near future. Soon we will let you know on our WhatsApp groups and other media that when we are launching this report, and on our website you can check maybe tomorrow morning under this smart category. There is a link for smart report. Here you can subscribe. Presently, the data available at Smart Report is for the past report, which was launched on 16th of March. So don't get confused. We are going to launch a new report tomorrow. Also, we want one favor from you. We have many WhatsApp groups. In fact, for all the seminars and workshops we have conducted in the city, in all the cities, in whichever city across the country, we have formed a group, a WhatsApp group, and those who are interested to receive a very limited messages, not even on an average once a day, they can send a request on this number 9755920780, and we will include you in that group, and all the information, all the messages, all the wisdom we share shall be communicated to you. So how our stock baskets fared, right? As I am telling you that the Sensex is down by about 8% from the peak, which was made on 15th of February 2021. And today, that means the last working day, 23rd of April 2021, the Sensex was 47,878. So the percentage fall is 8.1%. The similar fall in case of NSE Nifty is 6.4, and maybe because the stocks are different. What happened to SBP, or Smart Billionaire Pick? As you all know, there's a basket of stocks which was started on 30th of May 2001. Yes, about 20 years ago. Still 1 month to go. 1 month to go, and today its value is 96.3 lakhs. And on 15th of February 2021, when the Sensex was at historic high, at 52-week high of 52,154, on that day, Smart Billionaire Picks was 96.56. So, in terms of percentage, it is down by only 0.2%. Now compare this. BSE Sensex during this last 2 months and 8 days is down by 8.1%. NSE Nifty is down by 6.4%, and SBP is down by only 0.2%. Yes, there is one more similar basket, similar in the sense the similar type of product, but the stocks are pretty different. There is known by Smart Freedom Stocks, and here the downfall is only 2.3%. So These are the two basket type of stocks, products, advisory products we have in Smart VRC. And both these products have done wonderfully well. So what is the secret? What we are doing? What portfolio strategy we are applying? Why our portfolios are, our stock baskets are not down to that extent as to the BSE Sensex or NSE Nifty? This is how we have fared. The same thing on the bar chart. As you can see, the fall is very, very small compared to the BSE Sensex. So the secret of our success, as on date, we have about 30% of the allocation to the lifters. Yes, our portfolio, our advisory stock basket stocks are having a weightage of about 30% on lifters. And then don't care, we have only 5%. In fact, we have only one stock which comes under this category. Why we have held this? Principally, I don't believe in holding don't cares, but this particular stock has very high hidden value. That is why I have kept here. Otherwise, I don't believe in keeping don't cares. And then we have bulldozers, which is 65%. And these are very fast growers. When I say bulldozers, means I include only fast growers, no speculation, no stock without fundamentals or poor fundamentals. Now you can imagine what will happen if the market crashes. What will happen? If the market crashes, this 30% will try to give a small upward boost. This 5% will decline by a small amount, while this 65% will try to pull down your portfolio very highly, because these are the fast growers. Yes, people will discount the latest performance. People are not going to discount the performance of 2 years hence or 3 years hence when the market crashes. So these stocks will fall. I know very well that these will fall, and still I am holding it because I don't try to predict the market. No one can predict the market. And when the market falls, and our portfolio also falls, and many a times, in fact, most of the times, our portfolios fall much more than the indices. What we do at that time, what we do is we sell these don't care. We also sell a part of lifters, and we buy these bulldozers, because whenever the market bounces back, these bulldozers will far outperform the above two categories. That is how we are outperforming the indices over these 20 years. Out of these 20 years, for 14 good years, we have far performed better than the Sensex or Nifty or any other indices. And that is how we have generated 25.8% CAGR for 20 years. Basically, the strategy which I have told you, I have described during last 2-3 minutes, is playing on the beta. These are the high beta stocks. So these are the three categories of stocks: lifter, bulldozer, and don't care. Now, of course, I don't believe in predicting the market, but I would like to know your view. Do you think the market will fall from the current levels? Yeah, 50% of the participants have voted, have made the decision. Yes, I'm expecting more response. Please give your verdict. Means what you think. Will the market fall in the near future? So here is the result. 58% think that the market will fall, and 42% say no. maybe if you have given me the choice, I might not have voted. Sorry for that, because I don't try to predict the market and I don't know whether market will fall or not. But my portfolio is always prepared for both side movements. As you must have seen, we have a very appropriate mix of the lifters and the bulldozers. Thank you for participating in this poll. So this is a very famous quote from Benjamin Graham, and he says that if you are shopping for common stocks, choose them the way you would buy groceries, not the way you would buy perfume. What does it mean? It says that choose the stocks the way you would buy groceries. Groceries are our necessities. So don't buy the stocks like we buy perfume. Perfume is for only short term. Okay, this perfume is not a necessity. So if you are including any stock in your portfolio, that should be a necessity. That should be a very tempting buy and very good buy. So you should have about 16 to 20 good buys, good stories in your stock portfolio. That is the message given by Benjamin Graham through this quotation, not about the number of stocks, but definitely about the quality of stocks you should buy in your portfolio. So with this, we have come to the end of the presentation. And this will be followed by question answer session. You can raise your hand and I will ask you to unmute, or you can put your questions in the chat box. Thank you very much. Okay, you have any queries? Nice presentation, sir. What is approx beta for all three categories? I never target beta. I always look for the story. It is irrespective of the beta, because beta tells you only the volatility, and volatility should not be confused with risk. Mr. Gurudas, he says, which is the product for long-term portfolio? For long-term portfolio, I would recommend you to go for Smart Gains. That is the best product. And if you want more, if you want to interact with me, you can call me at the number which I have, which is appearing on one of my sites. On my right side, as you can see the number, you can call me here. Provide me new SBP pack starting with rupees 1 lakh. See it at any point of time. If I am holding the stocks, that means I am ready to buy those stocks. So it is whether I have started with 1 lakh or 10 lakh or 100 lakh, it hardly matters. Anytime you can join those stocks. If you ask me to prepare a new SBP, I will include the same stocks with the same weightage. Okay, very good webinar. Thank you, Mantriji. Is tomorrow's smart report part of the Smart Gains? No. Tomorrow's report is very unique. That stock we have not covered during last many years in any of the surveys. That is a very new stock, And company is very old, but a very exciting opportunity. Okay. Somebody has sent me a direct message. Should we keep buying stocks recommended in Smart Gain portfolio if it goes down up 10% or 20%? If you are following Smart Gains, then strictly follow the advice given under that scheme. Don't act on your own. Otherwise, the weightage, the allocation made will vary, and so the returns. Example of a bulldozer stock. Okay. I said there are two kinds of bulldozer stocks. One is with very poor credentials and one with excellent credentials. So with excellent credentials, I have already given the example of Bajaj Finance, and there are many more in that category. What is your view on IDFC First Bank? Sorry, sir, we have not recommended this stock in any of our services. I am holding Sundaram Fastener. Shall I increase weightage from 5% to 10%? Once again, I would request you to follow the weightage, the allocation we have given in our whatever product you have subscribed. On your own, if you do, then the higher returns or the lower returns, you will be responsible for that. Main parameters for stock selection in this situation. I have given you the great analysis, hence the analysis of the three categories. It is up to you how much risk you are ready to take. Mr. Dilip Sharma ji, many thanks, sir. This is my first webinar. You are always welcome, Mr. Dilip Sharma ji. We are hosting these webinars every week, and sometimes on Sunday, sometimes on Saturday. Can I include those smart report stocks to my SBP portfolio? SBP is separate. If you want, you can include in your portfolio. Of course, it is not necessary that you should only follow SBP, but we are not going to include this stock in SBP. I know you do not believe in predicting market, but do you not feel current COVID situation warrants caution and markets may correct sooner than later? Of course, we are taking situation of the harsh realities, and accordingly we prepare a basket of stocks. This is called as the case scenarios. What is the probability that COVID will be number of COVID patients will fall down from tomorrow? What is the probability that it may take 15 days? What is the probability that it may take 1 month? Of course, we cannot make any firm decisions, firm results. But behind the mind, you must be cautious. I'm not saying that you should sell the stocks. You should be cautious. If the market falls, is your portfolio ready for that? What are the stocks which we are going to fall? What are the stocks which you are going to sell partly? What are the stocks which you will buy? Of course, that depends what will happen when the market falls. But one should always be prepared. Okay, that was all about the chat box. Mr. Sunil Bhammani, kindly unmute yourself. Yes, sir. I'm not able to hear you. Yeah, tell me, sir.
I want to ask. If you are holding X stocks and even if doubles, but the percentage is negligible, so the risk is also the same. I mean, if you are holding X stock and it doubles, then you only gain. But I'm in a should diversify, but suppose I am having 2 lakhs and you diversify to be able to own only 5 to 10 numbers of that. I mean, what is the
Sunilji, we are
SR?
sorry to interrupt you. We are not able to hear you properly. What I could understand is what you are asking is if you have a portfolio of say 2 lakh rupees, then definitely you cannot buy the more number of shares.
Yeah.
You buy the limited number of shares, then definitely you can have more weightage, more allocation. Suppose you buy 6 shares or 10 shares, then on an average you can have a weightage of 10%.
Okay.
And as far as the risk,
Hello.
Hello, yeah.
Yeah. I'm hearing you. Go ahead, sir.
As far as the risk is concerned, risk has nothing to do with the weightage in terms of means because the risk and returns will be in terms of the proportion, in terms of the amount of investment you have made as a proportion to your portfolio. That is the allocation, that is the weightage.
I just want to ask you, sir, suppose if you invest 2 lakhs, you should diversify those 2 lakhs into 20 scripts or 50,000 की आप 4 में divert करो. मुझे सिर्फ आपसे ये guidance चाहिए.
So since the 2 lakh amount is pretty small, considering that if the share is priced so 2,000 rupees, so you cannot have more shares and you will end up with paying more brokerage. So I would recommend that you should have minimum 12 stocks, not less
Minimum.
than. Yes, minimum 10 to 12 stocks is the bare minimum. No,
I'm giving you a 2 lakh example only, then rest I will decide upon my this thing. But 2 lakhs is not so big amount, I can understand. But just for the sake of example, those 2 lakhs means maximum they should be divided into 10 stocks. Is it, sir?
not maximum. You can buy any number of stocks, but I would recommend you not to go for more than 10 stocks, because if you go for more than 10 stocks with 2 lakh rupees, you will end up paying more brokerage, because we are moving into the delivery basis, and delivery basis brokerage is about 0.4%, 0.5% in aggregate.
Okay.
So if you have 50 stocks for 2 lakh rupees, you will keep churning more and you will pay more brokerage.
Okay. Okay, sir. Okay, sir. And okay, sir. Yeah.
Tell me, sir, you want to ask for something?
That's the only and I'll interact with you personally on this thing, the numbers given regarding the portfolios and all you were told. I have got some communication from here end, but somehow due to time constraints, I was not able to get to you. I'll get to you personally.
Okay, sir. Thank you.
Yeah.
Mr. Prakash Singh, kindly unmute yourself. Yeah. Tell me, sir.
Good evening, sir. Thanks a lot for this excellent presentation.
Yeah.
And I'm also a subscriber of Smart Gains. So my question was related to this SBP product. In this SBP product, we do not come to know about the average cost price on which the stocks were bought. So, is there any way to find it out? Like,
Sir, if you visit our website, in website, you have got all the data. The day we started, that is on 30th of May 2001 to till date, whatever stocks we have purchased, the quantity, the price, everything is available there. And secondly, average buying price has nothing to do with your selling, because when you are selling, you are looking at the valuation of the stock, you are looking at the future story, but that has nothing to do with at what price you have purchased. So that has no meaning. For me, at least, there is no meaning at what price I have purchased. What matters is whether there is upside potential or not. That is the key thing.
Sir, actually, very recently, I would not like to quote the stock name because it is confidential.
Okay.
I was planning to buy this stock. It was part of this SBP, and I tried seeing this prices and all this and movement and all this and that. But in the very next 2-3 days, it happened to be that you sold this stock out completely from this your portfolio and you bought some new stock. So
Okay.
that's why I was interested in knowing that, like, it might give me a little idea about whether you are planning to hold it, or you might exit it if it is giving a lot of gains.
See, sir, as I told you, whether how much gains I have made in that stock, whether how much loss I am making in that stock, that has no relation to my decision to sell the stock. There is
Mhm.
absolutely no relation. So, and also there is a, maybe everything is perfect, but I found a new stock which has better potential than the existing stock. Then I can switch over. Again, I can sell that stock and I can include a new stock in my basket. So there can be many reasons. If you want to know any specific reason, you can write me, you can WhatsApp me, and I will definitely answer you.
Sure, sir. Sure. Thanks a lot.
Thank you. Mr. Vikas Dureja.
Yes, sir. Good evening.
Good evening.
Yeah, thanks. My question is, sir, in current times when investing in US stocks has become quite easy, and seeing the current times when we are still struggling with COVID, and it is expected that countries like US will come out of COVID before us, well before us. So I see three reasons in investing in US, just for the, for maybe a part of portfolio, not more than 10%, clearly for diversification and currency appreciation. So does these two reasons justify to have some diversification by investing in overseas market? That is my first question. I have one more, but yeah, so I would request you to address this first.
Okay. That is very interesting, and I also got a lot of queries regarding the overseas investment. If you go back 30 years or 40 years from now, or last 40 years, what are the kind of returns BSE Sensex has given compared to the US market, even after including the currency exchange rate change? You will find that the Indian stock market has given much better returns than the US market. But if you have a fancy for any particular stock, suppose you have a fancy for Facebook and you want to buy, you want to participate in its success story, definitely you can go and you can buy that Facebook. But as a market, I will not recommend to go for overseas just for the sake of giving a diversification, because already in India we have 1,000 good companies, including small cap, mid cap, and large cap. So we have got enough stocks, enough companies in domestic market itself where we can get good diversification. And secondly, regarding the COVID, if you would have asked me just 2 months ago, then you would have thought that India is better placed. But today, it seems that India is not that good placed compared to the US, and we do not know what will happen 1 year or 2 months from now.
Right.
Just
Yeah.
my opinion. Opinions may differ. I replied your query.
Yes, thanks. And I have one more,
Yeah.
and not related to this. Normally we see two type of broking platforms. One is the full scale like ICI or HDFC or many other, which is driven by the core banking platforms. And then we see the online Zerodha, Upstocks, Alice. And as per your opinion, are these, okay, safe, or how should one choose from the full-fledged, so which is supported by a banking system, or these online sort of brokerage platforms?
See, again, this decision may vary from person to person. I mean to say, there are some domestic brokerage houses which are providing good service. Even at my place also, I have a domestic broker which is providing me very good services. But again, these banks, especially this ICICI and HDFC, because these are both integrated, you need not have to shift the funds frequently. So they provide you better service. And as you must have observed that during last couple of years, many brokerage houses have defaulted, and the client's money is stuck up with them, and it may take years to resolve the issues, and maybe some of them may not get the money back. So be very careful, I would say. And as far as the brokerage is concerned, yes, the small brokerage houses, they are charging pretty less compared to these banks. But at the same time, when we are a long-term investor, our churning is pretty low, and we are targeting no less than 25-30% returns in a year. And in the process, if we give a 0.1% brokerage or 0.2% brokerage more, but with safety and with convenience and ease, then there is no harm. I would go with the banks rather than with the domestic broker houses, unless you are getting good advice or something, a good service from them, then it is a different thing. Otherwise, I will prefer banks.
Right. Right. Thanks. Thanks a lot, sir. Thank you.
For stocks recommended in smart reports, what is the exit strategy? We are giving a stop loss as well as the target. So that is the exit strategy and also the holding period. What should be the allocation between equity, debt, and gold for retail investor? See, this may vary depending on your risk profile. In general, I would recommend that you should have about 10% to 15% investment in gold, and about 30 to 40% in debt, and the remaining in equity. When I say debt, debt means inclusive of your provident fund or any such EPF or GPF if you are working for a company. So this is my opinion. Is Smart Gains product for long-term perspective? Okay, in Smart Gains we have two parts. One is pick of the week, and the second is the Smart Billionaire Picks. Smart Billionaire Picks is for long-term, and pick of the week is for short-term. I cannot say short-term, but short to medium-term. Investment horizon varies from about 6 months to 2 years, and that is all about the Smart Gains. For a 5-year period of investment, shall we start with SBP? Yes, you can start with SBP. What is SBP? I am not able to find it on your website. Okay, it is there under Smart Gains. When you are visiting our website, go for the product Smart Gains. Under Smart Gains, you will find SBP, Smart Billionaire Picks. You will find the chart compared with BSE Sensex. So this was all from the chat, and we have one more query from Mr. Sunil Bhammani. Yes, sir.
Yes, I'm missing the middle word. What are you telling? S?
Smart Billionaire Picks.
Okay. And is it appropriate to discuss directly regarding it, or I should discuss in person with you?
Means
I want to know how the way this your scheme works. I mean, you manage it. We'll have to shell out money to you, or you guide us. What is the modus operandi of the schemes?
We are only advisors. We are not brokers, and we are not portfolio management service providers. Money will be with you. We will only advise you.
And against it, you charge it.
We are charging only for the advice. Our charges are. It is not the profit based or anything like that.
Okay.
Not linked with the profit. We are only for the advice, and that is fixed for every product.
I had received one communication from your end whereby you had just guided regarding one script. So you will be posting every script weekly basis, monthly basis. How is the machinery of this thing?
Okay, we have different products, sir. In Smart Gains, we advise every week. In Smart Multibagger, we advise about 15 stocks in a year. So it is all different. It's all schemes are different kind of schemes, different frequency, like that.
So we should contact you or some other sir? So
you can call me at my office. Maybe I can also pick your call.
Okay. These two numbers, no, sir?
Yes, sir.
Right.
Thanks. Lakshmi Lalwani ji. Mr. Lalwani, sir?
Hi, sir.
Yes, sir.
Good evening.
How are you?
Okay. So I'm doing good. How about you?
Yeah, fine, doing fine. Yeah. Tell me, sir.
So I have one question. Like recently, I read one article. Like you might have also heard that like a U.S. government is increasing the long-term capital gain around 45%.
Yes.
So I heard that like most of the big investors, like in India and other countries, this long-term capital gain is less, whichever going to be introduced in U.S. government. It will be very high in U.S. now. So now they will like move their investment from U.S. to other countries, developing countries like India and on. Like,
Okay.
what is your opinion on this? So this is like a right syndrome is good time for Indian stock market. Like, should we invest more in the like such developing countries?
Okay. Uh, Firstly, there is only a rumor. The government has yet to declare that capital gains tax has been raised. And secondly,
Yeah, they propose it.
investing for the other countries, say the developing countries, then you need a good advisor, because investing on your own in other country, it's very difficult to research a stock. Because if you ask me to research, say Zoom stock in US, then it is really very difficult for me to research sitting over here in India. So you need a very good advisor if you are planning to invest in developing countries. And I would prefer to wait, let the US government declare that capital gains has been raised, and then you can take your call.
Yeah, when I say other countries, so it will be India, and I have an advisor in India, you. So what I will do, I will transfer my money from here to India, then I will invest more in India.
Okay, that is, you are always welcome, and you are already with us, I think, from last
Yes,
1 year.
2 years. Yep.
Yes. Okay. So we are always there to serve you, and even without rising capital gains, we are giving you about 26% CAGR, which is much better than US markets. So
Yeah.
yeah, you are always welcome.
Sure. Thank you.
Thanks. Presently, you are in US, right?
Yeah, in Chicago.
Yeah. Chicago. Okay.
Yes.
Thank you.
Thank you.
How should gold proportion be invested? Physical gold, ETF, gold funds, or gold bonds? Okay, this is a very interesting question, and what I do, let me share my way of investing in gold. I always buy the ornaments for my spouse because I get double returns. My wife is also happy, and I also get a diversification in my portfolio. So it all depends on you. If you also want to enjoy double returns, then you can choose this option. Otherwise, you can, if you have sufficient investment in gold jewelry, then you can go for gold ETF. That would be the best option, I believe. Thank you, sir, for a webinar. It is enriching. What should be the stop loss when we buy a stock in percentage? As such, there is no thumb rule for putting a stop loss. And normally, one should not put a stop loss. Stop loss should be considered only when the market is falling pretty fast and your stock is falling much higher rate than the market. Or if the market is stable and your stock is leaving the market. Leaving the market means it is falling consistently. Though the market is stable, but your stock is falling consistently, that means there is something which you do not know, but people in the know are acting on it. So that should be the reason to apply a stop loss. Or if the company performance is way below your expectations. What are your views on mutual fund investing versus direct equity investing? I told you, if you have got a good advisor, then you should go for direct equity investing. That will give you much better returns. Even when you are investing through a mutual fund, you are paying about 2% to 2.25% of your money in terms of the advisory fees, in terms of the expense ratio. So if you have a portfolio of, say, 10 lakhs, so 2% of that is 20,000 rupees. So instead of providing that money to your mutual fund, if you can find an advisor who charges only 5,000 rupees or 10,000 rupees and gives you better returns, then nothing better than that. Go for a good advisor. But as I keep on saying, finding a good advisor is more difficult than finding a good stock. So with this, we have come to the end. And thank you very much for sparing your valuable time. And be very careful. As we all know, the number of COVID infections increasing day after day. Thank you very much. Thanks.